So what became clear a couple, maybe 2 months ago, is I guess the VIX got very low and there was a consensus that we would have a soft landing. Will Powell stick the landing? Have we tightened enough? And we're not going into recession and it's off to the races. One of the things, and frankly, I'm questioning that. I think that there are a lot of possibilities of things going wrong, but it doesn't mean that they will go wrong. But I think that you should be aware of what some of the problems are, and we'll go through that. The first issue I have, and I mentioned it last month, is Janet Yellen, said, Fitch never should have downgraded our debt. It makes no sense whatsoever. And frankly, I think that that's a naive comment. And I think that the downgrading of U.S. government debt by Fitch was deserved. There are risks. And, this is a consequence of both the Treasury and the last couple Fed chairs. I think in retrospect, definitely having maybe engaged in policy in retrospect. And right now, I think that for one, I've got a question with Janet Yellen. I think that we're looking at an environment where we have had declining rates for 40 years. Those rates are now going higher. And so there is something called recency bias. People look at what's worked, think that's just the way the world is. And I think that people are comfortable with the market always going up and interest rates going down. This is the picture that I'd had last month, but I'm going to continue that. Forgive me if this is a little small. I'll try to improve that. But Janet Yellen had said after Fitch had downgraded the U.S. debt that this downgrade was totally unwarranted. Fitch's decision is puzzling in light of the economic strength that we see in the United States, Janet Yellen said. I strongly disagree with Fitch's decision, and I believe it is entirely unwarranted. And this was on August 2nd. And right below that, I have a chart which I got off the FRED database. That's a St. Louis Federal Reserve database. And it shows what the government outlay is to pay for our debt. And what we see is that in 2020, we were paying $516 billion a year just to pay the interest on all the debt. We got $33 trillion. And now it's almost $1 trillion. It's as of, I think, the end of last month was 969 billion. So nearly doubling over the course of 3 years. Double it again, it's $2 trillion in 3 years, and double that again, $4 trillion a year in 6 at the rate we're going. This to me is a disaster. So for her to say, "Oh, the economy's strong," is completely ignoring the consequence of some of the financial engineering that both the Treasury and the Fed have been engaged in endeavoring to get us past the out of the great financial crisis and the Great Recession. And now we've got inflation. Inflation rates are going up. And because of that, interest rates are higher. And now the massive debt we have accrued is leading to massive outlays. The cost to cover our debt coverage it is accelerating on the upside, and that's unsustainable. So we haven't been talking about budgets with the intensity that we had decades ago, but suddenly people are coming back to this. And frankly, it's a problem and it needs to be dealt with. I will try to move quickly. The Fed or risk premium model, I like a great deal, because what it does is when you're thinking about global markets or markets in general, it's not just a stock market or a bond market, one or the other. The two are actually related, and they're related on a valuation basis. And what the Fed model or risk premium model does is it relates it. It basically looks at how expensive are stocks relative to yields that you can get in the U.S. Treasury market. And basically, they do that by inverting the PE yield, or what they call the earnings yield, on the S&P 500. And the earnings yield on the S&P 500 has declined. You want a high earnings yield, and when at the bottom of 2008, it was very high. And so that meant stocks were very compelling. And when yields were very low in 2020, you could have stocks looked very cheap because bonds were in competition. Well, now interest rates are moving up, and relative to the earnings yield, that spread is going to zero. And frankly, the last time we saw it negative was during the bubble in 2000. And frankly, I'm concerned that interest rates will go higher. Now, in terms of total valuation, one methodology is what they call the Buffett indicator. You take the Wilshire 5000, you divide it by the GDP, and I guess cognitively, it gives you an association historically between hard assets and paper assets. And so when that Buffett indicator is very rich, it tells us that the market's overvalued. It is. Where right now it's 47 trillion for the Wilshire 5000 to 27 trillion in GDP. It's a substantial premium to what it normally is. And to come back to normal, a 43% decline in the S&P 500, I think, could occur. Now, this doesn't have to happen overnight. I'm not saying it's a crash tomorrow, but I think that we're in a period like the 1970s where energy, commodities will do well, and I think financial assets are going to struggle. Robert Shiller, very smart guy, got a Nobel Prize. He did a lot of work in terms of behavioral finance, but he has his 10-year CAPE ratio. And one way to look at PE, so you don't get confused by the cyclicality, is take a look at it over a 10-year basis. And then you look at it over 140 years, and you can see that the PE on the S&P 500 today is 30.8. That is above where it was in the peak in 1966. It's below where it was in 1929, and it's below the peak in 2000. But it is well above the historic norm. And I have, on that same chart, you have long-term interest rates. Interest rates, and I think this is a big picture that when you talk about a sea change or a psychological problem, recency bias, everyone just imagines that interest rates are always going to decline. If you have declining interest rates, buy stocks, buy bonds, buy real estate, and those values are going to go up because interest rates are declining. Well, they're no longer declining. They're going up. And frankly, I think that they can go higher. So I would argue that there is no reason that the CAPE ratio could not go to 20. And that would be consistent with history. And there's no reason, in my opinion, that we couldn't see 10-year U.S. Treasury yields go to 6%. Hope not. That would be bad for the market, but it could happen. Now, one of the problems that I think we need to monitor that is a contributing factor to the current set of circumstances I see as problematic is that the CRB index.
Let's put this on the bottom.
To break out. Ed, I'm going to. The CRB index, well-known index of commodities, is largely energy related. So I think JP Morgan put out something. Oh, there it is. JP Morgan's head of EMEA energy research, Christian Malik, said that, Brent by 2026 could get to $150. If that happens, the CRB is going to be way up. That's going to be very inflationary. And if we have inflation, we got a problem. Because if we've got inflation, the Fed's got a mandate to bring inflation down, so they're going to raise rates. And that's part of the problem of what's going on in the market today. And I like to look at historical analogs, or I like to look at charts over a long period of time. And what I have is the CRB On the left, you got a 25-year chart. And the last time I think we went through an inflationary commodity cycle was from 2000 to 2009, and oil went from about 20 to about 170, and then it declined until about 2020 when it got down to about $12, and now it's taking off. And the CRB often parallels oil, but in all the commodities tend to be highly correlated. In my opinion, we had a very strong move up from 2020 to about 2022 when the Ukraine invasion first occurred. But then lo and behold, it seems that energy prices have backed off substantially. We certainly saw that in natural gas, and a lot of the shortages were resolved. But now it looks like things are starting to firm. And taking a look at the 1-year chart, it looks like you're breaking out of a consolidation pattern and could go higher. And certainly, if expectations are for higher energy prices, I think that that's a certainty and would be inflationary and problematic. Now, another factor in the market is the Magnificent Seven. We had the FANG stocks, Facebook, now Meta, Amazon, Apple, Netflix, which has been dropped, at least from the FANGs, Google, Microsoft, Tesla, NVIDIA. Those stocks have had massive moves. They're all, in aggregate, they're up about tenfold in the last 10 years. And having spent a lot of time looking at charts over my career, parabolic moves tend to act badly. This looks like we got a double top, and this move is parabolic. The valuations are extreme. I think this reminds me of the Nifty 50 in the early 70s. This reminds me of 2000. It also reminds me a little bit of 1929. And I think these stocks are disproportionately responsible for the strength in the triple Qs, the NASDAQ 100, and the S&P. And I think that you don't need to see these stocks collapse, but simply to have more normalized PE multiples. And I think that that would be very negative for the markets in general. One idea that I like conceptually is the idea that we are in a commodity cycle or a super cycle. And a super cycle is a commodity up move of over 5 years. And if you look at this, I'm not sure how clear that is. I'll try to expand it a little bit. Over expanded it there, sorry. If you go back, and I think it's very useful to look at things over periods of time. Since 1870, I mean, most of us don't remember the bull market of the 1920s. We do remember the Great Depression. The Great Depression actually had inflation, but it was during a deflationary period that you had a massive move in stocks in the 1920s. We had deflation following World War II up until the 70s, and then you had inflation. And this is the period that I think is the historic analog that is most appropriate to what we are experiencing today. Now, back then, oil prices went through the roof, so did oil. I believe those are possibilities. But then, oh, I don't want to see that. I don't want to see that. But you all may read, I'm sorry, folks. I just lost my presentation. Hold on. There we go. But we had a fabulous bull market after that inflationary period of the 70s and the 80s and the 90s. And we got a bull market peak, a tech peak, and then we had an inflationary period. And again, oil and gold did extremely well from 2000 to 2009. And then they ran out of steam. And you went through a deflationary period, and the Fed and the Treasury worked to keep interest rates very low, and stocks went crazy. I think that we are now entering an inflationary period. We have clear evidence that we have inflation, and I think that we could see inflation, an inflationary cycle, and again, probably owning energy stocks and a variety of commodities, I think would be very sensible from an investment strategy standpoint. Let me click this one more time. Okay, bring that back into. And so this gets to me to the last slide. Anybody who's looked back at the 1970s, as they don't remember it, that was a terrible period. I was in school, so I've had to more study it. But apparently, the Federal Reserve in the early 70s tightened interest rates to reduce interest rates, and interest rates went up in the early 70s. And then it seemed like the Federal Reserve said, oh, it looks like we got inflation conquered. And they started easing, and then lo and behold, inflation took off. And during that period, interest rates went way up. How much did they go up? From 1975 to 1982, they went from 7.5% on the 10-year Treasury to 15.8%. That was devastating. It was the late 70s, early 80s when Paul Volcker came in and he started tightening. And that just was a miserable period for the stock market. We want to avoid that. But what the difficulty that I foresee, deja vu, the 1970s second leg, is that if we have inflation, what is the Fed going to do? But they're going to have to continue to tighten, and that could crush an economy that is already getting crushed by increasing interest rates. I'm Tyson Halsey. You all know who I am. Thank you, everyone, for being on here. The next speaker I'm going to have is Rich Gula. Rich has spoken here previously. He's a brilliant guy. He went to Harvard, which I understand is a good school. I'm trying to get you to unmute yourself, Rich Gula. You there? I didn't get rid of you.
Here we go. Hello. Here
Okay, so let me continue with the intro.
Yes.
Studied psychology, undergrad and grad, worked for two iconic financiers, one Dean LeBaron, who was one of the first indexers and quantitative strategists, a billionaire in his own right, and also Ned Johnson, who ran Fidelity, which in the 1990s, when Rich Gula was there, was the big whale of investing. And he has, throughout his career, worked with lots of institutional money. What his work skill set is looking at charts and doing quantitative work and thinking about markets. And he has, and he currently advises, I believe, 6 mutual fund managers over at Fidelity, running billions. So what he has to say is worth looking at. And I called him this morning, and we chat periodically, and he's seeing interest rates go up. And so Rich, you got like 30 slides, but we got 15 minutes, so let's move through it. Fly like the wind, I think, is what somebody once said.
I will do that. The
crisscross, that's it. Who
yes,
could forget crisscross?
One of the chief tasks in my life right now is to find a theater that will show the new Top Gun movie, because I like the Lady Gaga songs and I want to hear them in the theater. But that is an aside that gets your mind off of the craziness of what we see going on right now. You can't see it because I've got it on my phone, but I went into the Fred database when Tyson said the magic word. And I always look at the velocity of money chart first, because I was taught by a very, very successful and famous local hedge fund manager named Jerry Jordan that if you have rising money supply and no velocity, you have a Fed that is actually worried about deflation. But deflation is on the back burner right now because, as Tyson points out, there's ample evidence out there that there's something else going on. The other major announcement was he called me and mentioned that Arizona had some interesting political pots boiling. And I said, well, the pot that simmering in the back that nobody talked about was that James Bullard, who used to be the keeper of the Fed database in St. Louis, quietly resigned from the Fed in August and is now the head of the business school at Purdue. And that's an interesting departure because he's the second data guy. Richard Clarita, you recall, who had been on the Fed, was a very good data guy, and he kind of disappeared as well, right? Supposedly because of some trading that was inappropriate. So you've got four people leaving the Fed, two of whom were stalwarts. The Dallas Fed, Mr. Kaplan, was also quite well known for keeping a good Mexico, Latin America database, the parallel Fed. But I only say that because if you've got a Fed that's data driven and the data guys are leaving, there's a little problem. Not quite sure what it is, but we'll go fast. The first thing that jumped out as I prepared was that when I talked to my senior friends that all worry about having missed the rally, and now they want to buy, and I said, well, the market's plus or minus 10 from here, and you can get 5% for a year for doing nothing, and they all are going to buy 1-year T-bills. So there's some interesting competition. Next slide, please. The bugaboo here isn't the 30-year. Tyson may recall, I recall friends running across Boston in 1980, desperate to sign for a 16% mortgage because they were certain that the mortgage rates were going to 20 and the money markets were at 20 at that time. And the 30-year, I think, peaked out around 14 and a half, right? But that's a bad memory. With the attack on the 10-year is very curious, and we'll come back to that at the very end. But it smells like there's a problem out there somewhere in ETF land, and if you own corporates and mortgages and they have, let's say, 3, 4, 5% coupons, and the bids on those things aren't so good, I guess you would probably sell liquidity, and that means you'd probably sell your 10 and your 5 years. So that's the bad news. The good news is the money has to go somewhere. I underlined PepsiCo because the presentation today is a classic LeBaron, contrarian, Ned Johnson. I know everything that's gone up. Tell me what hasn't gone up, and let's try to make some sense out of that. So I went through the S&P 500 pretty diligently. I got through about 80% before I kind of ran out of space for Tyson's presentation. And the names that pop up there are going to surprise you, I think. However, PepsiCo, which was down 3 yesterday when I took the snapshot, was one of the few uptrends. So now it looks like they're going after, this is a harmless stock.
Do you want me to go to the next page?
Yeah. Go to the next one.
I'm sorry.
All right, let's go. But with that backdrop, just go. Yeah,
buy that Cheniere.
Yeah, like Cheniere. Those are the recommendations yesterday. Stop there for just 1 second. That's okay. This is I always watch the halftime people, so they're all hiding in stuff that's safe, which makes sense. I don't mean hide in a pejorative sense. They're giving ideas to people in a chaotic situation because they had an extensive discussion and during this hour about rates and where they were going. And so these are all pretty safe stocks and pretty decent charts, as I recall. I haven't looked at FedEx, which took a hit. But this is the data that they were throwing up, which is, of course, September goes down hard. And the 2023 actually understated it because there was then a big dip early in October. And then what happens on the upside? And this understates what happened off the October 12th low of last year. Because by November, the market was roaring, November, December, and everybody was saying it was a bad rally. And I've been brought up by a number of mentors to love bad rallies. So there's a bias. Next chart.
I threw this in because it was disparate.
Yes. Thank you. Oh, thank you for getting that in there. There's something ugly going on here. At that trough a year ago, this ETF, which has a daily volume of around 1 to say 3 million, traded 37 million shares in 2 days. So either the Warren Buffett types were just waiting for high volume and a reversal, or somebody rescued this whole complex. And this happened across the board in the corporates. It happened in the BND and the LQD, which are very much different structures than the mortgage back. So if this thing is going to keep going, and it was 5 million shares the other day, normally you need a big volume reversal to begin to think positively. I think that there's something going wrong in the credit markets, and we're being diverted with inflation talk and hawkish stuff this and politics that. But fundamentally, in the structure of the market, there is no joy somewhere. Okay, we can go through some stocks now. We're going to go. Oh, this if you are running into folks saying, but earnings and multiples will be a problem a year out. This is IBIS. I followed IBIS my entire career because it started about the time that I started. And it's a pretty reliable indicator of where earnings are likely to go. This isn't as much forecasting as everybody kind of giving their best estimate without talking to each other and coming up with a number. That's a pretty optimistic view a year from now as to where we're going to be in the market in terms of earnings in the S&P, even with the magnificent or not so magnificent 7 doing their thing. Okay, next chart. We can jump over that. Okay, we're just going to go down very fast. These are, you can kind of see the stocks as well as I can, and this is the sort of chart that I'm emphasizing here, because these are the stocks that missed. Somebody either there's a management problem or there's an earnings problem, or you'll see in some cases there's stocks like Western Union that may not have a business anymore in the world of PayPal. And then you look at the PayPal chart, and PayPal doesn't have a business. And does that mean we're all going to crypto and so on? Well, all right, let's go. We'll go fairly quickly now. Next chart.
Baxter.
Baxter. This is a relatively unknown drug stock, as we all know. How in the world are these guys in a context of contracts and heavy exposure to their products in a positive way? How can you take a stock down this hard during what's one of the best rallies in history? I hate to point it out that way, but the one from October 12th, whether you label it a bull market or a bear market rally, was a pretty good one for a lot of stocks. Next. Conagra should be going up. This is a staple stock. This is a safe stock compared to Pepsi, because you could stop eating whatever Pepsi makes. And I confess I eat a lot of Pepsi products, but that's a whole other matter. But that was something reversed. See the spike. There was a change both in sentiment and in cash flows for defensive stocks that was quite abrupt. That's about as near a parabolic as you get in a food stock. We're not talking NVIDIA someday going from 400 to 800 and going all the way down like the .coms did. Next stock. We saw a couple of them here. Yeah, Disney and Dish. So Disney, how can you screw up a Disney franchise? And I'm not saying they did, but boy, the market verdict on these guys is pretty negative during a time when ETFs are buying everything. And Dish, I could see where maybe that business model's got an issue. But next stocks. Etsy is I didn't know anything about this until a friend of mine said, gee, you ought to take a look at Etsy. There's some interesting stuff there. And I knew it had been a new issue not too long ago. Boy, does that look like a .com that's going out of business. And I'm not saying they are, but boy, that's a nasty selling in a company that is pretty well acknowledged, especially in younger demographics for buying consumer products. Next. And lo and behold, if you can't make money in Conagra, you certainly could do it. General Mills, Post Toasties, so the Crack Snapple Crock, whatever, I guess Snapple, no, Crack Snackle.
Crackle Pop.
Crackle. Well, that's old people have trouble with these things. You would have told everybody if they own this to stay with it. that looks like somebody is bailing on a macro something issue in the market that has materialized and is yet to be completely revealed. It could be linked to the budget discussions right now. We'll know in a couple of weeks. Next, please. We should have a lot more of just negatives now.
Gap
GPS,
stores.
Gap stores. The problem with Gap stores is that you have to invite in the looters and give them refreshments and let them take what they want and then wish them a good day. You can't do anything. Some of the recent video out of Philadelphia was pretty interesting. But the cynical view was, did you go to Apple or Lululemon first? And the answer was, you should have gone to Apple first, because then when you got your Lululemon items, you could take selfies. But that sounds like a cynical view. But if you're in Philadelphia and you're trying to run a reasonably, these are pretty good companies that have real problems right now. I think they're calling it shrinking or something like that. Shrinkage. These are two that go back a long time. I'm not really sure what international flavor and fragrances did, but early in my career, this was a staple stock, and sure isn't anymore. And what's the other stock? Let's see.
I want to say Illumina or something.
Yeah. It's a name that you think they know what they do, and maybe they're having some problems figuring their identity out. But boy, that's completely out of favor as well. And the whole idea of doing this is, at the end, build a portfolio out of these. Dean LeBaron would say, if you equal weight them, you'll outperform on a 6 to 12 month basis versus anything else. We buy all the stuff that's down, as long as you at least run a decent quality screen for cash flow, et cetera. All right, next, please.
All right.
Yeah, like it. So nobody's buying furniture. If those of you that know the West Coast, there's a tiny house movement on the West Coast. And I would guess you don't have a lot of room for furniture in a tiny house. So maybe that's a factor. But I just think that that's a pretty quality consumer company that is way out of favor. Next.
Mid-American apartment communities.
Yeah, the REIT complex. Everybody's talking about the problem being commercial real estate. My recollection, I didn't get a chart of it because I didn't have an ETF source, but the BX, that's the Blackstone commercial, it has actually rallied off its low pretty well. This is supposed to be the area that would be working. And I think one of the problems is that the yield, although there's a red line over it, these yields are down around the 3-4% area, and that's too low for the risk in the stocks. Next.
Lumina, LUMN, and LUV, Southwest. Especially Lumina, that look like a liquidation. They're going to normally you would create a merger portfolio, and you'd buy a basket of those, and you'd buy 10 of them, and 3 of them would work, and the others would go out, and the 3 you bought would go up 300%. And the strategy works. That it's tough on the clients though to survive that. But LUV, that's of the best. It's supposedly, in my experience, in Delta, JetBlue are very well run, and Delta is in there pretty close, and United and American have gotten a lot of bad press. Next, please. That could be. Don't forget, LUV used to hedge the price of jet fuel, and that was one of their advantages. Maybe they got the hedge wrong. So here we got Mohawk. Mohawk was always around during my career, and now nobody ever talks about it, and you can see why. And again, and I throw these into contrast. MDT would be showing up in most value screens as interesting as a place to rotate to. I'm guessing that the analyst would die at the thought of you buying it right now. But that Dean LeBaron would say, that's why we don't have analysts. We just have computers. Next, please. Northern Trust. Northern Trust is in
my, of the investment advisory type banks, it has a franchise that is certainly strong nationally. It may have global. I don't know if they have global offices. Um, that you would maybe is this all what rising interest rates do to a group? It's a highly quantitative investment shop by reputation, by the way. They could have been on the wrong side, but I'm guessing their wealth gathering folks are doing just fine. Something else is wrong there. Okay, next.
We have 4 charts.
Yeah. And this was just to contrast that you could occasionally find something that was going up, even in the midst of the chaos of what's going down. And ironically, the up chart is Old Dominion trucking. And you would think, well, with gasoline, all of the things you've heard about supply chain issues would argue that Old Dominion should be having a problem, and so you want to own that. The other, the O is a realty trust, and let's see now, Newell. Newell is an old consumer name, as I recall, and News Corp I threw in only because Rupert Murdoch is gone. So, will the hardcore Republicans have a platform? The rumors have been that Murdoch's family, that has sort of editorial control, is going to put a lid on this, but we'll see. All right, next, please.
Public storage.
Public storage. The public storage would be that would begin to show up versus the other REIT that we mentioned, the apartment REIT, that doesn't look so good. This would be getting close to being interesting to own, but it also it's just a cash flow cow. It has been for a long time. Next, please.
PayPal and Qualcomm.
So PayPal does a lot of advertising. I use PayPal extensively for sending money to a friend or two, and certainly for anything I buy on eBay. And their service is absolutely perfect. I've never had a problem. That means it'll all go wrong within the next week, but that's okay. But boy, they're certainly having trouble convincing the market that they've got a viable model. And they probably not. Maybe next time, Tyson, we should get a digital currency expert that's positive, that's going to convince us that. I haven't paid cash at Starbucks in years now. I just flash my phone, and if I can do it, anybody can do it. Qualcomm should be doing a lot better. As I recall, Qualcomm competitively puts a lot of products into Apple phones, and Apple certainly has been fine, but there's a minor problem there. That's looking like a value stock.
Next.
Yeah, next, please.
Okay. VF Corp.
VF Corp, and I think Target was above that, but don't worry about it. Target, Kohl's, VF Corp, Tapestry. Boy, these are premium names in the consumer discretionary area, and they are all under tremendous pressure. And I think it's got to be more than just the looting kind of factor that they're now beginning to publicize. I've seen a fair number of clips. If I see it online, I don't take it seriously. But if I see it on MSNBC or CNBC, I begin to think, okay, it's out in the open now. Okay, next, please. And Walmart.
Yeah.
Yeah, I did a lot of international investing for a long time, and whenever you saw a domestic company and an international company bond together, we always decided it would go down, just on prejudicial thinking, and it's gone down. But I doubt that's for real reason. But there's certainly a franchise there that's pretty strong, and it looks like Target. Okay, next. Let's see. Western Union is self-defined, I guess. We don't have to say anything more about that. I'm not sure what they do anymore. Next.
Zebra Technology.
And Zebra Technology. Zebra was a favorite stock of the aggressive growth guys, and it has gone way out of favor. The other observation that if we could make a phone call to the New York Stock Exchange Library, I'd love to ask them the number of stock splits that have occurred in the last, say, 6 or 7 years versus the previous 6 or 7 years. There are an all large number of stocks selling above $200 and $300 and $400, and I think that's because there's no pressure for management to split because the access to stocks comes through ETFs now. Much cheaper for an ETF to put $10 million into a $400 stock than a $40 stock. All right, I think that's the last slide. Or no,
no,
or one more.
Yeah.
Yeah. If you go online and you can get this book, it was done in 1970-71, and it has been a core to my sort of approach to market analysis, never mind technical analysis, for my entire career, which is going to go back 45, 46 years now. All I tell you, it's by a guy named William Bretz. It never shows up in the best books on technical or market analysis, and I have it in the top 5 that was ever done. So it's a little giveaway, and if you could track one down, be sure to read it. All right.
Okay, I have 2 other people I want to speak. First, I'm going to have Mitch Belagic. As I mentioned previously, he was a quantitative strategist for ITG back in the day. He's calling out of London, and he has a particular interest or focus has been on commodities. Mitch, could you please unmute yourself and tell us what you're thinking? Okay. I'm going to stop the share and start speaking. There you are.
Okay, can you
hear
me?
Yes, we hear you and see you. Fire away.
Okay.
What's going on?
Yeah, well, difference from Rich Gula, I'm going to be very short. I don't have any charts to show, and I'm going to be very much macro oriented. Yes, commodities, macro in general, but I would just like to mention a couple of bullets, question marks that I'm asking myself and everyone that I don't think is covered in the media and with a lot of investors, including the CNBCs and Bloombergs of the world, that are really kind of bothering me. So let me start off. I think there's a real serious connection between the major commodities. We know the drivers are right now, the bond and the oil markets, but there's also a story behind natural gas. There's also a story between uranium, and they're all interconnected, and directly also interconnected and influenced with China and the bond market. First of all, the oil prices, my real concern with oil, when we constantly look at inflation and CPI's core, and we never look at the oil and food as the volatile factor. Yes, they're volatile, and the report you can take it off, but the fact is that consistently high oil feeds into the core really seriously. And people keep on saying, like quoting the price on the gas pump, that is only 20% of the oil market. The rest is from truckers to chemical industry to this and that. Now, you heard everything that's going on. There's absolutely not one thing that is going against crude oil right now. And a lot of geopolitical tensions and the Russian and Saudi moves are really serious. And I think that there's a direct correlation between the prices of crude oil and inflation. And that's just a testament that inflation's here to stay. And we're actually going for another leg up. And this is the 70 scenario. Tyson said 6% on the 10-year yield. I really think by the end of 2024, it's going to be around 8, the way things are moving now. The bond market, one thing that's not covered, I'm not going to get into details why the yields are going. We all know what it is. But one thing that's really underplayed in the market seriously is the fact that the Chinese and Japanese are seriously dumping treasuries. And they're doing it through their offshore accounts in all three time zones everywhere. And mind you, I don't think really the Chinese are very much concerned if they're going to be an elephant in a glass shop. In fact, I think they'll be very happy to destroy the U.S. market with all their bond holdings, and that is exactly what's going on now. I've been noticing a lot of really awkward moves in the Asian market. Not last, but the Sunday before last, there was a big incident that no one reported in the media. Yields across the curve around 2 a.m. jumped by 0.5%, and they abruptly fell down. The explanation of this is a glitch. Glitch doesn't happen across the yield. Glitch happens on one instrument. There's some serious trouble going on with the Treasury and the central banks and the yield in general. It's not a matter of what's going to break. It's just a matter not when, but what and when it's going to break. And I think this part of the story is way underplayed. Now you can add Janet Yellen, you can add commodity super cycle and whatnot, but the biggest factor and the biggest destroyer right now is the potential of the Japanese and the Chinese dumping bonds. And mind you, they need cash. Yes, they're going to be losing on their positions. They're making it up a bit on the high dollar, but they need serious cash. And that is what's going on. And especially the Chinese, I think the clumsier they trade, the better. And Fed cannot avoid that, or Treasury, anyone in the US. Natural gas has been depressed for a while. I really think natural gas is going to follow the destiny of crude oil. And crude oil at this prices doesn't justify natural gas where we have it right now. I think fundamentally Europe is having problems again. I think supply issues are getting tighter. And I'm really expecting that once we break out of this very narrow low range, we'll be back extremely close to the levels we saw during the Russian initial invasion to Ukraine. So I would be very careful watching the natural gas, because the natural gas breaks out and all the elements are there. It would be a much bigger destroyer than the crude oil at 100. And that brings me to uranium, which I was very bullish on for a while. Not much attention to uranium, but if you think that the revision of the nuclear plants around the world, from Japan to Europe, even the Greens in Germany are not against nuclear energy anymore. Interestingly enough, uranium is in huge demand. That's the only way we're going to get out of this crisis. And forget renewable energy. We all know where that's getting us. Little known fact to people is that uranium is the only commodity that's not under sanctions with Russia, simply because Russia doesn't produce a lot of uranium, 15%, but they refine 50%. So we got a real problem here. The demand is growing tremendously. Again, another geopolitical factor to watch. And also one more thing with the crude oil, I forgot to mention also, China actually. China reopening is a big disappointment. Really puzzling factor with China is China's robustly buying commodities, including crude oil. And this is not refilling the reserves either. So my question is this China, after all, picking up? Or maybe they were not in that bad of a crisis as we all wish they were in. But it's very puzzling. It never made sense that there would be such robust buyers of commodities if their economy is on the verge of collapse, which is also another factors why we have the crude prices at this level right now. So in my view, it's not crude and yields only have way up from here. And if we have natural gas joining this rally, we're going to have big trouble. But that's really my focus. Yes, it's mostly like a commodity focus, because that's where a lot of the action is. But I will keep a very close eye on the 10-year yield. People haven't given up in already concluding it's going up to 5%. I believe it's going to breach 5% if it doesn't exist, and that's where really things are going to start looking ugly.
Thank you, Mitch.
That's
Tony Lobeer, could you give us some of your veteran insight into what to believe and not believe?
Okay, I unmuted myself, I think.
Yes,
Can everybody hear
but not
me?
your TV behind you.
Okay, that's easy. Okay. Look, I think that the big problem is that we're running a $2.5, $2.4 trillion deficit at the same time that the Fed presumably is trying to tighten. Now, given the deficit we're running, and given that we have a war, and given that we're having another war against fossil fuels and trying to do whatever we're doing to China, inflation is inevitable, and an increase in inflation is inevitable. But the real danger you have is that because the economy is so far been relatively resilient, which I think is more to do with the deficit spending than anything related to the so super American consumer. I mean, you're on a collision course, which eventually is going to result in a crash. So right now the market looks and acts oversold, and so maybe we're going to get a rally, but this is a very dangerous period because people are not taking the problems we have seriously enough. Now, one thing that came up, and that is, I think it was Moody's. I'm not sure which of the three said that they may downgrade the U.S. debt again if the government goes out on strike. Well, it looks like that's going to happen, I think that the increase in the price of oil is another political issue. I mean, we've said, I mean, we're trying to boycott Russia, and we've told the ruler of Saudi Arabia that we're very upset that he chopped up a journalist. And, you know, people don't like that. So, I mean, I think we're in bad shape, except perhaps if in oil and maybe precious metals eventually. Very difficult to time. So I'm just being very careful. One peripheral area that I think is interesting.
Also, you can guess a lot.
What?
Sorry, that was somebody in the background. Tony, is your TV still on?
What?
Is your TV on?
No.
Okay, good. I know I'm getting some background.
Okay, I mean, one peripheral area that I think is kind of interesting is the domestic marijuana stocks. And the reason I think they're interesting is because the government, Kyla, um, the government has said they want to declassify marijuana from a class 1 to a class 3 substance. And this would be hugely important because it would very dramatically cut these companies' tax bills. And I think it's going to happen. I mean, all the other marijuana initiatives have been dependent on the Republicans. This one is not. I think Biden needs something to gain support. I think this is be a very popular measure among Black people, particularly, which has been one of his big support bases. So I think this is going to happen sooner rather than later.
Thank you. Anthony Gagliardo, you have a question. You need to unmute.
Yes, I'm here.
Yes,
How are you?
have a question.
Okay, yes. I have a symbol. The company is called Tellurian. They've been on the map for a little bit now, a few years now. I don't have I don't have the information in front of me, obviously, right now. But I wanted to know what everybody's thoughts were. They're building a facility called Driftwood. They have Bechtel working the site now, doing the construction. And they're trying to get, they're trying to get final notice to proceed. But they're also trying to get final investment decisions. And it seems to be ongoing. Okay, when I bought Tellurian a while back, they were 80 cents. They're a small cap. Okay. And they've traded anywhere from 80 cents to $6 because they're pending on news of getting the, obviously the funding and stuff. So I was wondering if anybody has any thoughts on it, or they could put it on their map to see if they think something like this is going to happen as far as the financial support. And that's
Thank you, Tony.
kind of where I'm at. Yeah,
Tony, it happens that there are several people on this call who own it or have owned it or follow it. Certainly I do. I like it. I spoke to somebody who said that somebody from Bechtel, I'm not sure whether they said the CEO, somebody from Bechtel was on the site, Driftwood, last week. They have made a further adjustment to their business plan where they are securing offtake agreements. And what Tellurian is doing, the reason I find it of great interest is I like to invest with guys who are proven successes. Elon Musk, Steve Jobs, multiple successes. Somebody who was successful with one company, they're successful with the second, then maybe the chance that they'll be successful in the third is logical. And the case of Sharif Suki over at Tellurian is he was the founder and co-CEO of Cheniere, symbol LNG. Stock went from 1 to about 183. And I've been very interested in it and hoping that he would repeat the magic that he did at Cheniere. But it's been a rough road. Now, part of that has to do with the fact that they have a different model. They're actually looking to capture the spread between Henry Hub and international prices. And that is a different model than what most of their competitors have done, which is sign long-term offtake contracts and then just get a compensation, a tolling fee. And what that tolling fee by comparison is much smaller. If Tellurian can put together their financing, I think that this is an $8 stock, potentially in the first quarter of next year. Last year, the stock was around $4. They tried to put together a financing. It didn't happen, and the stock actually traded from $4 down to below $1. So where it is currently around $1.18 when I last looked, it is pretty inexpensive. I think people have been discouraged that they have not been able to put it together. but the executive team, I think, is very talented. Their CEO, Octavio Samoz, was over at Sempra LNG. He's got a lot of contacts with, let's say, Saudi Aramco, and Suki, has a lot of international contracts. These guys are keynote speakers, and I think that they are pushing hard. One of the things that got me particularly comfortable with the idea that you could get their financing was that a company called Blue Owl has entered into a sale leaseback, which could produce $1 billion. They obviously know the people in the upstream and the downstream side, and they're trying to secure equity there. With the new model that they've been talking about, getting offtake agreements, they believe they should be able to get some infrastructure. We have been seeing financing of other LNG deals. Warren Buffett recently came in with Cove Point, which was already existing. Here's a company, $600 million, $680 million market cap. However, if they succeed, and based upon what Suki says, and anyone who is interested should go to their website, tellurianinc.com, and look under news, and he actually makes routine updates. He was talking about $1.7 billion in cash flow in 2029. And with the last two trains, that could add another $3 billion. And so if you were actually to then put a 5 multiple on something, let's say, call it a $4 billion cash flow, it's a $20 billion company. And from a $600 million valuation, that's more than 20-fold. Obviously, there could be some dilution along the way. But one of the things that I noticed, and I looked at it this morning, is Henry Hub looks like it's bottoming. The TTF, which is a Dutch international contract, looks like it's starting to move north. The idea is you take $2.90 Henry Hub, you turn it into a liquid, you ship it anywhere in the world. Once it's on the water, you can send it to Asia, you can send it to Europe, South Korea. You can send it to a lot of places for another $2. But the spread between 2 and 14 is huge. And so that is a very compelling profit opportunity. They are the first people to do it. It's a new business model. Dell was a new business model when gave Compaq a hard time a long time ago. Tesla was a new business model, but not all new business models work. But I think that they're at a point where they have a lot of conversations with a lot of people in the industry. They've indicated how they see this structuring coming together. And my bet is that we should see something, a simultaneous closing in the fourth quarter. And, there is risk here. But the fact of the matter is the operating cash flows improve when Henry Hub goes up, and the spread improves when the TTF goes up. And right now you're starting to see Henry Hub goes up. And since they own properties in the Haynesville, they're able to sell those, generate cash to continue to build. It's risky. But if you were to look at the stock, you would say this is a value stock. I think the most bearish people are saying the stock's worth 87 cents in a distressed sale. So at $1.18, not bad. If you start to get some of these contracts announced, and I think that they've indicated that they should be announcing things going forward, and that's what we hope for. But if we start to see that happen, I think you could have a very significant run in the stock. But I think the risk is you could get 1 or 2 or 3 announcements, but they never fully pull it together, and then it falls back as it did last year, and that would be disappointing. But obviously, if you can own something at $1.20 and it goes to $8 over the next 6 months, there's a lot of money to be made. I think it's consistent with the idea that I want to be out of generally financial assets and I want to be in commodity plays. So it's a highly speculative opportunity, but it is an opportunity. I think it's an asymmetric upside downside. Any other questions? And everyone's on mute, so if you can click on that thing that says raise hand or
Hey Tyson, check the chat. I put something in the, I put a question in there.
All right, so let's see. Do you want to read it to me? So, how does Saudi Aramco purchase Halsey gas assets play into TEL? Well, I'd say first, I think that all natural gas stocks right now look washed out and are turning north, and I would be very keen on that. How does Saudi Aramco purchase Halsey gas assets? Everybody is competing for these assets, and that's all I can say. I think that Saudi Aramco has if they're becoming greener, want to probably own more natural gas assets just to diversify away from oil. So I could see them as a potential funder of Tellurian, but perhaps they want to buy Halsey assets. I think that I think the idea of diversifying for Saudi Aramco makes a lot of sense.
Comstock, that's a Haynesville gas play. You know those guys at all?
I believe, does Jerry Jordan own that?
The Cowboys owner, yeah. He basically reverse mergered into it. So they've delevered like crazy. Stock was as high as 20 when the gas market took off, a year ago. And I don't quite understand the dynamics, but is Haynesville not necessarily the cheapest? So I think they curtailed production when prices came down, but you're sort of indicating prices are going back up. So if the production might increase a little bit with higher prices, I'm still sitting there with a core position. I sold some at the higher levels, but if anybody knows anything about that company, I'm all ears. It's hard to get.
I think they're all highly correlated, and it doesn't matter whether you're buying something in the Permian Basin, whether you're buying it in the Haynesville or the Utica Marcellus. If Henry Hub goes up, their profitability looks better. So you can own EQT in the Utica Marcellus. You can own Comstock. You can own Antero Resources, which is also in the Antero Resources, or Southwest Energy in the Haynesville, or any of the numerous plays in the Permian Basin. And the relationship that I have or to tell is the Haynesville is about 150 miles north. I think maybe they're not the cheapest natural gas, but close enough. But once they can liquefy it, they can put it on water and they can ship it anywhere, and international prices are much higher.
Yeah.
Alan DeLugash, please unmute yourself and fire away. You usually have a good question or two.
No, it's with me, listening to everybody, I kind of agree with what everybody's saying, but it's just the uncertainty level now is crazy. And, we can talk about, it's funny, people talk about charts, looking at this, looking at that, but to me, it's all fundamentals. And the one fundamental that is going to make or break everything we're talking about is the election next year. If we have Biden coming back in, we're going to have the struggle. The deficit's going to go crazy. It's going to become the number one topic. The talk about the Chinese and the Japanese liquidating treasuries. It's only going to be the tip of the iceberg if the debt keeps going, the deficits keep going crazy. To me, whatever we try to plan for, it's either going to be yay or nay based upon the election next year.
Well, my view, the best way to avoid that is buy things with little downside, which is one of the reasons I'm saying 60-40 is probably no longer a valid strategy going forward, and having 25% in cash and short-term treasuries makes sense because we simply just don't know what the answer is. I'm sure we all have opinions, but my inclination is to think that energy is very cheap, and I think gold and the commodities are all cheap, and that's where I think that there is more safety. But I don't know. I don't know how to play the election other than react when it occurs.
And that is exactly what I think. I don't think we're going to know. We may get some good information as we get much closer to the election, but the election has there's three parts. There's a Democratic win, there's a Republican win with Trump, there's a Republican win with somebody else. The Biden is a disaster. The others are certainly a hell of a lot better. Trump being the middle and non-Trump being the best, clearly, for the economy. But if we don't see anything clear, I think everything is going to suffer because even the safe stocks, I just wonder how safe anything is going to be if we start totally imploding. The other thing that I haven't heard much from people say, well, maybe interest rates are going to go back down again after this, once we get inflation. I don't know how we ever get inflation totally under control when you're still having $2 trillion deficits every year. And I don't see that changing. But more important, when people think interest rates are coming down, we've lost sight of the fact that the natural order of things, in my view, and I guess a lot of other people, is that interest rates are going to be 200 basis points or thereabouts higher than inflation. So even if we get inflation down to 2%, which I'm not sure is going to happen anytime soon, it still says 4% interest rates. So the people who think that, mortgages are going to go back down to where they were, or anything's going to go back down where they were, are just, drinking the Kool-Aid. I mean, we're not. This is going to be, I don't know how we get, we had that 10, 15-year run of low interest rates. I mean, that's an anomaly. 50 years from now, we're going to look at that and say, how did that ever happen? But didn't happen before, and it's not going to happen again.
Well, I completely agree. I think that that's what created a bubble in bonds, a bubble in stocks, and a bubble in real estate, because really all of those three asset classes provide cash flows of reasonable predictability. And when you have interest rates drop, that simply by definition means those cash flows are worth more. And now we are reversing that bubble. And I think that really history is going to say that the Fed and the Treasury really mismanaged finances over the last 15 years. And that's going to create a lot of problems.
Tyson, I have one
ahead,
thought.
John. John, go ahead.
Oh, go ahead. I'm
sorry, John, I muted you.
There you go.
Fire away.
All right. Looking at the mortgage market, there's a lot of 3% and 4% mortgages out there, and people's homes are up substantially. I bought this house 2 years ago, and to my amazement, because I thought I was buying the top, it's actually, looking at comparables, worth $150,000 more than what I paid. I got a 3% mortgage. But you have a lot of people owning that paper out there, and you have a market where everything's gone up. The banks, portfolios, fixed income portfolios are stuck with 3% and 4% mortgages that are not rolling off and won't roll off, because I'm not going to sell this house for $150,000 profit, go out and buy something in the mortgage, and get a mortgage for 7%. So
Sure.
unless you find unemployment and people having to sell, it's going to be hard for portfolios to recover, I think, because they own all the 3% and 4% paper.
Well, I think there's another element going on too, and that's the commercial mortgage area. I think I was listening to somebody talking to Maria Bartiromo this morning about some Cleveland commercial property, and maybe it was associated with Evergrande or one of the Chinese real estate entities, and they're willing to sell it, at a loss now to get out. And a lot of banks have a lot of these commercial mortgages. That was like the safe money because real estate always goes up. And suddenly, these things are inverted. Actually, at one point, I was very interested in IEP because Carl Icahn owned credit default derivatives on commercial mortgages. And the argument was, people don't come back to the office, and you can't keep up with your mortgage payments. A lot of this New York real estate could be underwater. And how that plays out is only going to be exacerbated by higher interest rates. And so, yeah, I think if we have higher energy prices and that forces higher inflation, things could get ugly. And so I would be concerned both about residential as well as commercial real estate. And that's all I have on that.
The banks, I think, would like you to default, so they get that 3% mortgage off the books. They get to sell your house at a higher valuation, and they get to generate a 7 or 8% mortgage.
Do you want me to call your bank?
Not yet.
Any last comments?
Tyson, just one thought.
Go ahead.
If the crisis that is materializing, as just noted in the mortgage area, that MBB is acting as if there's a big exit from it, and I can't believe there are buyers that are going to support it. However, if things get bad enough, much like last October, you could get a reversal in here where you're oversold enough across a broad spectrum of stocks and get a better rally into the end of the year than any of the data would have us ever imagine. So this isn't a forecast, but I see that especially if you see cryptos moving, it means that there's broad pools out there that go into everything simultaneously. It's sort of a tip of the iceberg where the iceberg is coming up out of the water rather than sinking lower. But maybe that's just hopeful, optimistic fantasy, but maybe not.
One last comment I have. Go ahead, Mitch.
I just have a quick question to Alan. Alan, do you really think that this whole global economy can actually wait for the election next year? I just doubt it. I mean, if things go sour, we're talking about months. Election is away like more than a year. So I don't think the Biden administration really understands this. I think they can just print their money out of it. I don't think they even understand how deep in a hole they got themselves in. Powell understands it, but he's helpless. His last conference call, have you people noticed how inconsistent and scared he was? I mean, he's having a problem lying himself. Never mind Janet Yellen, she's half retarded.
No, she doesn't have any problem lying. That's the difference.
I'm afraid
I'm
not sure whether she's lying or just doesn't know what she's doing.
No, she can't. No, she can't be that stupid because she was out there. Remember, she's the one who said a long time ago, when Trump was in office, she was criticizing his fiscal policy. And now, when she's smart enough to realize that Biden's fiscal policy is what's destroying the country, all of a sudden she thinks she's got to be supportive, like the nonsense, Tyson, that you said before about there's no justification for the downgrade. The only thing that's surprising to me is that one of the three rating agencies hasn't done the downgrade. That's what's surprising to me.
Well, I have one final comment, and this isn't a slam dunk, but I think that we can make a reasonable bet that all of the Magnificent Seven are probably expensive and probably a safe bet to short. And I'm not I wouldn't go crazy with it, but two names that are easy for smaller investors to take a position are SARK, which is the short on the Kathy Wood, one of her mutual funds, and the SQQQ, which is I think a double short on the triple Q, the NASDAQ 100, because that's where you really have high multiples. And if there are liquidations, that's where you're going to see it. And I don't see those things really flying up in your face. The comment was made, and I'm not trying to be a short-term trader, but Rich Gula probably knows as much about that as anybody, that we are rather oversold, or maybe it was Tony, and we get a bounce. But I think that you can have more cash. But I think if I was looking to put on some sort of short, looking at those large caps, I think you could short Apple probably with relative impunity. Any last comments? And then we'll
I just want a specific answer, Mitch. I agree that nothing is going to be waiting for the election. I mean, things are going to be happening before. I'm just saying that whatever is going to happen because of the disarray that we have now, the election is going to put an exclamation point on it, one way or the other.
No, it will.
I would say this: if Biden is reelected, and I don't want to sound political, and the disastrous policies that have been implemented over the last couple of years continue, we really do have the 70s. We really do have 8% 10-year treasuries, that sort of thing.
Well,
and I don't care whether it's Donald Trump or Ramaswamy or DeSantis. I don't care, but I think you need to have people who want to shrink the size of the government and bring this into control and believe in small government. Otherwise, I think we've got a real problem. Mitch?
Hey Tyson, can I end this call with a
Yes,
quote
go
from
ahead.
Thomas Jefferson?
Fire away.
People deserve the government they vote for. So if Biden comes here, so fuck us all, we deserve it.
That is actually brilliant, but it's also it's not just on the national level. I've said it so much about the cities. I'm in New York City, but New York City and San Francisco and whatever. I've actually stopped donating to all city charities or that help the poor people in these cities, because I'm saying, if they're going to keep voting themselves the stupidest people that don't serve their own interests, why am I going to be enabling them? Maybe they'll have to learn the hard way. Tough love. If you vote for the stupid people, suffer the consequences, and then maybe you'll come to your senses.
I think one of the most interesting things that I heard on the debate was Nikki Haley saying that she would defund all the sanctuary cities. I come from New York. I love living in that city, and I feel very bad for seeing what is going on there. And I didn't realize that the federal government is funding these sanctuary cities, but if it is, that's unforgivable. So I like the idea of defunding that. I'd like to thank everyone for tuning in, and you all know how to reach me if you got any questions. John, do you have a comment? Oh, you're waving goodbye. Okay, goodbye, Duncan, Tony, Mitch, Alan, Richard. Thank you all.